Good day, everyone. Our paper topic is bank financial intermediaries and economic growth in Nigeria. The major objective of this study is to check the effect of bank financial intermediaries on economic growth in Nigeria. Actually, we have what we call both bank and non-bank financial intermediaries. Example of bank financial intermediaries are commercial banks, agricultural banks, merchant bank, microfinance bank, and so on. And any companies that carries the name of banking. Example of non-bank financial intermediaries are insurance company, cooperative society, Nigeria Deposit Insurance Commission, Security and Exchange Commission, and so on and so forth. That is any organization that do not carry the name banking. That is the introduction aspect of the study. Now, we have, just like I mentioned on the literature review, we have bank financial intermediaries. Bank financial intermediaries and non-bank financial intermediaries as one of our conceptual review. So, talking about the theoretical review, we use economic growth theory. Economic growth is closely related, is closely linked to the intricacy of financial system. A well-developed and effective financial institution helps in allocating financial resources to the best uses in the rich sector, thereby promoting economic growth. As the sector grows, the demand for financing increases, and in this way, the financial sector grows in tandem with economy, signifying a two-way causal relationship between finance and economic growth. In developing countries, just like Nigeria, financing generally flows from both the banking system and capital market, while in most developing and transaction economy, the capital market is lagging behind, which shifts the burden of financing to the banking system. The growth model relevant in this study is neoclassical model of growth, since the growth model explains the situation in the developing countries, just like Nigeria. The neoclassical model of growth was first developed by Robert Solow, and the model believes that a sustained increase in capital investment increases the growth rate only temporarily. Research methodology. This study uses ex post facto research design, and data was collected from CBN Statistical Bulletin, that is Central Bank of Nigeria Statistical Bulletin, in which SPSS package, statistical package for social sciences was used to present the results of the data collected. And the study formulated two models, two equations, and one of them is credit performer formula 1, and the second one is credit performer formula 2. In the first equation, which is credit performer formula 1, GDP is depending on total deposit money bank credit. That is, GDP happens to be dependent variable, and total deposit money bank happens to be the independent variable in the first model and the first equation. Then the second equation, GDP happens to be the dependent variable, and the total microfinance bank happens to be total microfinance bank credit happens to be the independent variable. And according to the results, it was discovered that there was a positive relationship between the dependent and independent variable in the first equation, and the coefficient of determination of 92.9% also make us to know that the dependent variable is well explained by the independent variable. Also, the ANOVA makes us to understand that the relationship between the dependent variable and independent variable are statistically significant, since the value is less than 0.5%. In fact, the value is 0.000. And also in the equation 2, the 0.940 of correlation coefficient makes us to understand that there is positive relationship in the dependent and independent variable, and the coefficient of determination also makes us to understand that 84.4% of the coefficient of determination makes us to understand that dependent variable is well explained by the independent variable. Now, also in that equation 2, it was discovered that the relationship between there is statistical relation, as in the second equation, the ANOVA result is also less than 0.5, and which is making us to understand that there is statistical relationship between the dependent and independent variable in the second equation. And the study recommendation, the study made us to understand that according to the study, the recommendation is based on both the findings and objective, and the study therefore recommends that deposit money banks should encourage greater liquidity to improve their capacity to pay for consumer withdrawal and enhance loan and advances to customers for productive purposes in order to increase gross domestic product. Microfinance bank should also provide sufficient finance to the risk sector for productive uses to boost the GDP, that is gross domestic product. Then the study also recommends that bank lending bank lending rates supposed to be reduced, so that in order to allow investors to see banking as a #1 source of the finance, so that they can patronize them, and the financial intermediation strategy will be strengthened. And the study recommends also that commercial banks should make efficient use of deposits mobilized in efforts to improve the level of profitability of banks, which will boost commercial banks' activities. Thank you.